Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. AI growth trajectory called into question. Investors have been bidding up stocks related to artificial intelligence for the past couple of years, as if the growth trajectory of many of these companies was infinite. No price was too high, and any skepticism or pushback was met with instant derision. This is a new world we're entering, or so we're told. And maybe that's true, but castles don't grow to the sky, and stocks don't go up in a straight line forever. The market is starting to finally question whether or not the capital expenditures behind AI are sustainable or even financeable, as Oracle is currently finding out. That company is actually looking to scale back or delay some of its data center projects due to funding constraints. Investors are also starting to question the ultimate return on investment, given the very high level of expenditure required on the front end for many of the tech companies. Previously seen as asset-light businesses that required very little in the way of capital investment, near-term cash flow projections are plummeting as capital requirements to build out AI infrastructure escalate. Now, AI is certainly not going anywhere anytime soon, but 2026 may be the year where investors realize there's a lot of opportunity out there to make money in things that aren't necessarily AI-related. For this week's featured insight, the market doesn't care what you paid. Well, aside from the obvious tax implications, it really shouldn't matter what your cost basis is for a particular stock holding. A stock that trades for $100 doesn't care if you paid $50 or $150 for the shares. The only thing that matters is where the stock goes from here. Now, the future is uncertain, of course, but when you decide whether or not to sell, hold, or buy more of a stock, what you paid for the original investment should be irrelevant. Many losing positions have been held onto for much longer than they otherwise should have been by investors hoping to get back to break even. There's no guarantee that a stock will ever recover to the price you paid for it. And even if it does, it could take a lot longer than you think to get there. So I'll let you in on a little secret. You don't have to make your money back on the same stock that you lost it on. Looking ahead, investors approach 2026 with optimism. Investors tend to be an optimistic bunch. How could they not be, putting hard-earned capital at risk in the markets every day? At the same time, most good investors are always considering what could go wrong, trying to avoid the biggest pitfalls while taking advantage of the best risk-reward opportunities. And after a somewhat tumultuous 2025, most of the research and analysis coming out of Wall Street is quite constructive on the outlook for next year. There's an expectation that the market will continue to broaden its participation of winning stocks from just a handful of large tech companies into more of a rising tide lifts all boats type of trade. Now that means owning more small caps and cyclical stocks that typically fall into the value category, which is something many investors have been ignoring over the past few years. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.